The institutions are coming. How many times have we heard that phrase during the last bull market cycle? And while allocations may not have come at the pace and volumes that some anticipated, or perhaps hoped for, there are signs that there's a lot of work that continues to happen behind the scenes, even in these bear market times. When I talk to our members, many indicate they're still planning to put new money to work in 2022. Yet, operational due diligence is one of the key hurdles they must clear before putting money to work. So let's start by defining some terms. When I talk about institutional investors, I'm talking about those big ticket allocators, your pension funds, your insurance companies, endowments, and foundations. When it comes to digital assets, they're generally investing in private funds, hedge funds, venture capital, fund of funds, rather than in the tokens themselves. And here you can see how much of the assets under management they now comprise of the legacy hedge fund industry. Now, when they're investing, they're taking market risk. That's the risk that they hope is going to generate those outsized returns. But they're also taking operational risk. This is business risk that can negatively impact their investment, yet doesn't generate alpha. So, of course, they're looking to minimize this. And one of the ways they do this is through a robust operational due diligence, or ODD, process. This typically involves key stakeholders and interviews with them, as well as document reviews. And they need to be sure that they're catching the red flags that can be common in this asset class. So what does this look like? They're going to look at risks that are going to be common for all alternative investments, including digital assets. So we have things like governance, essentially the people, your ownership, your staff, your decision-making, as well as operational risk. This is a broad bucket, which can include compliance frameworks, anti-money laundering, cash management, market manipulation, counterparty risk, etc. You then have risks that are common in alternative investments, but much more acute when it comes to crypto. So here we have custody and trade execution. So how an investment firm has selected its chosen custodial provider, for example. You also have cybersecurity. Of course, cyber attacks are a risk of pretty much anything these days, but in crypto, they can wipe out a portfolio in a matter of seconds. And then you have those digital asset-specific risks. So things like smart contract and protocol risk, as well as key management if an investment manager is using any sort of self-custody. Here you have it. Institutional investors are moving up a steep learning curve so they can confidently assess risk and make investments. Investment managers in digital assets should be prepared to answer these questions transparently and effectively. I'm Michelle Noyes, Managing Director and Head of Americas for the Alternative Investment Management Association.